Alright guys, I think I'm falling hard for Williams-Sonoma, ticker symbol WSM, which is one of the key players in the home furnishing industry. Now I've only just recently added this company to my watch list, but I'm already head over heels. I think their financials look rock solid, as does their current valuation and dividend stats, so suffice to say, I'm pretty smitten. And in this video, we'll be doing a deep dive on Williams-Sonoma, but before we get into that, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow portfolios and collect that cash flow. Anyway, getting into Williams-Sonoma, this company was founded back in 1956 when Chuck Williams, who had a burning passion for cooking and loved entertaining his friends over food, opened up a store in Sonoma, California that was dedicated to selling French cookware that he had become really interested in when traveling across Europe and couldn't be found anywhere here in the United States. Now, this first store and the emphasis that Chuck placed on customer service really set a high standard and allowed the business to thrive and over time grow into what it is today, which is the world's largest digital-first, design-led, and sustainable home retailer. Now, many of us are probably already familiar with the namesake Williams-Sonoma brand, who has a reputation for selling high-quality, stylish kitchen products that are made to last. But one thing a lot of people don't realize about Williams-Sonoma is that they also own a handful of other very popular home furnishing brands like Pottery Barn and all of its variations. You've got Pottery Barn Kids, Pottery Barn Teen, and even Pottery Barn B2B, which is a huge growth initiative for them where they service the hospitality industry, residential and commercial spaces, university housing, other retail stores, and much, much more. They actually shared some of the recent B2B projects with us in the last earnings call, and some of these projects include outfitting the Carl's Jr. corporate office, one of the Google offices, the Golden Guardians esports facility in Los Angeles, and a large number of hotel projects for Marriott. Anyway, along with the namesake brand and the various Pottery Barns we just talked about, Williams-Sonoma also owns other brands like West Elm, Rejuvenation, and Mark & Graham, all of which have been great ways for them to diversify their sales. In fact, these other brands have been driving the majority of the company's sales. If we take a look at this slide from their recent investor presentation, out of the $8.7 billion of revenue they did in 2022, only about 15% came from the namesake Williams-Sonoma brand, which I think actually speaks to their ability to meet the different needs their customers have and the variety of styles they're looking for, because Pottery Barn, for example, is going to have a different price point and look than West Elm, and West Elm will be different than Rejuvenation, and so on and so forth, so they're able to better accommodate a wider range of tastes and budgets. And what's really impressive is that across all of these channels, most of these sales are coming from e-commerce. Going back to the investor presentation, 66% of their revenue came from online sales in 2022, which shows that they're really on the ball when it comes to evolving and adapting to technology, and is another example of how they're meeting their customers where they need to be met, and it's paying off. Taking a quick look at some of their financial stats, first and foremost, their revenue growth is looking rock solid, and over the last 10 years has grown by an average of 12% per year. Also, their earnings and free cash flow growth is very consistent, and in the same time period has grown on average by 24% and 32% respectively, and along with this, to sweeten the deal for shareholders, Williams-Sonoma has been buying back shares pretty aggressively over the last decade and has done a great job of growing their dividend as well, so they reward shareholders here pretty heavy. And actually, taking a quick look at their dividend stats, their forward dividend yield is sitting at 3.08%, which is actually about 25.4% higher than the 5-year average, which is great. And checking out the rest of the stats, these are looking great as well. The payout ratio is sitting right there under 20%, so it's nice and low with plenty of room to continue paying and growing this dividend well into the future, which they are certainly doing, guys. Look at this 5-year growth rate. That's really high, sitting right near 15%. I love to see that, especially with a 3% yield. I think this is a really nice combo here. And last but not least, they have a really nice dividend growth history of 16 straight years, so it looks like they're pretty committed to the dividend. Now, having said all of this, just like any other company in existence, Williams-Sonoma is not without its risks and potential downsides, with consumer spending being probably the biggest primary red flag. If we are to fall deeper into a recession, people will likely spend less money on home furnishings and kitchen products in general, which would reduce the demand for what Williams-Sonoma has to offer. And while it would likely be a temporary issue as the economy tends to ebb and flow, it's still something to keep in mind if you're considering this company as a potential investment. And this is also a reminder for why it's so important to buy these companies at an attractive valuation, so you can establish a margin of safety and hopefully mitigate some of that downside risk. And on that note, taking a look at this company's share price performance, it's pretty clear that Williams-Sonoma has already seen plenty of downside. In the last year, they're down 17%, and this drop in share price has brought that PE ratio down nice and low into the single digits, currently sitting at about 8.5, which is actually 34.6% lower than the company's 5-year average PE ratio. So it's looking to be more attractively valued than it historically has over the last 5 years. In trying to come up with a concrete fair value for this company, I did a discounted cash flow calculation, and even assuming a 0% free cash flow growth rate, assuming that that free cash flow doesn't grow at all, and applying a 10% margin of safety, a 10% discount rate, I got an intrinsic value for Williams-Sonoma of $178.62, which means it's about 34.5% undervalued. And just for reference, if we compare this to Alpha Spread's base case intrinsic value for Williams-Sonoma, they came up with $171.14, which would mean it's about 32% undervalued. So it's really not too far off from that. And then making another comparison, looking at Morningstar's fair value for Williams-Sonoma, they have it at $211, which would make this company even more undervalued. And having said all of this, as far as what I'm doing with Williams-Sonoma, for now, I'm just going to keep watching it to see if the share price gets even lower. I mean, if we are headed deeper into a recession and if interest rates do keep rising, I could see lower prices for this company and others out there as well on the horizon. And honestly, I feel pretty good with where my portfolio is at overall right now, so I can be patient. I'm not in too big of a rush to add any new positions right now, so I feel okay just keeping my eye on things. But I'll tell you what, from everything I've seen so far, Williams-Sonoma looks like a great company and also appears to be deeply discounted. And if you want to hear about some more deep discounted dividend stocks, then check out this next video right over here. In this one, I'm telling you about 4 really solid companies that also look to be very attractively valued and look like good pickups right now in the month of April. So click right over here to check them out, and I'll see you in the next one.